Hello and a warm welcome to Portfolio Watch. I'm Kukulethu Mfupi. Now, the technological evolution or fourth industrial revolution is met with angst, leaving the perception of many losers and few winners. The reality is it's more of an equalizer, as everyone has access to the same technology. Now, we're living in exciting times for investment opportunities given the pace of advancement both locally and globally. We must, however, never lose sight of valuation, specifically when it comes to companies that are presenting a concept that is not a reality yet. Well, we've got a full program for you in store this evening, taking a look at all things having to do with the fourth industrial revolution and the digital age and the investment priorities that they do set up for you. My guest in studio to unpack this for us is Andrew Ditburner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Mark Ingham, Director at Ingham Analytics. Gentlemen, great to have you both with us here today. I'm actually observing the technology at the table, and I think we need to bring up that calculator, right, Mark? It's perhaps something that is well known in the market, but of course changing times as that calculator is now on our cell phones and many other technological devices. But let's talk about the climate that we're in. This fourth industrial revolution sends some chills down many individual spines. Friend or foe when it comes to technology? Let's start with you, Andrew, and get your thoughts, Mark.
Yeah, I think it's a very exciting time, I suppose, to be alive, when you see what's happening. And from a sector point of view, you need to have exposure to the sector. From if you're talking about equities, global equities, likewise, the China, Asia, developed market story. It's a strategic imperative that you have exposure to this sector. But it's nothing new. So when you talk about a revolution, if you think back many decades and technology, where we've come from, the 70s was mainframe computers. The 80s, we had mini computers, then you went to desktops, then it was the internet, mobile technology, etc. So every 10 years, we seem to be moving, or having a new technology cycle, if we can call it that. And I think now we're starting to move into, or have moved into, this cycle that talks to data or big data. And I think there's a number of technologies that play into that theme, which opens up a huge array of investment opportunities, as you say, both locally and globally, which I'm sure we can talk to a few of those in a short while.
Indeed. It does seem to have rattled the landscape slightly, and of course what everyone is hoping for is that we don't see a repeat of that .com bubble, right, Mark? Because this is where the concern tends to come in when we take a look at the amount of technology companies available and, dare we say it, the valuations.
Correct. We were chatting off air, Andrew and I. We both attended the CFA conference recently in Hong Kong, and there was a large Asia orientation there, and it's quite interesting how a number of these companies, both private companies and listed companies, are out of China and Asia. So we're very familiar with the Microns of this world and the Googles, but there's quite a landscape of opportunity out there, but you have to tread very carefully. And I think to your point about valuations, some of them are on relatively stretched valuations. Micron, which we're discussing today, is a company with a less stretched valuation, but it's effectively being priced for a through the cycle, because DRAMs, for instance, random access memory devices, do tend to be a sort of cyclical. So we have to bear that in mind. I think if one does one's fundamental research and your homework, you can probably justify a price earnings multiple of 20, 25, 30 or even higher if the rate of cash flow generation is going to be fairly rapid. And I think the pace of technological evolution is such that it's difficult to get a sense of what the future can bring and present value that. And therefore, I think keeping a level head with respect to these things is actually very, very important. Perhaps a point to bear in mind, though, is unlike .com, many companies we're dealing with today are intrinsically profitable. So we're not quite looking at price to revenue multiples that we were looking at 15, 16, 17 years ago. So many of these companies are cash flow positive. They may be reinvesting sort of materially. But I think although you have to be cautious and one size doesn't fit all, the technology companies that we have today that we can choose from, by and large, are reasonably profitable.
Yeah, I'll tend to agree with that. I think if you look back in the early 2000s, and you just compare it to like price, cash flow, price revenue multiples, we're not even a third of the way to where we were back in 2000. I think another important point is the capex cycle. In the 2000s, the companies were right at the top of the capex cycle. And as that fell away, as the spending reduced on IT spend, that obviously hurt a number of those IT companies. Whereas today, if you look what's happened over the past 10 years, is that non-IT businesses haven't been increasing their capex spend towards IT-based solutions.
That would be a concern to an ordinary investor,
yeah,
right?
but now they're starting to pick up again. As we move into these different areas of, call it cloud computing that plays to your big data, etc. They're starting to invest in those areas, which is obviously a tailwind to the companies that supply, be it the hardware, the software, etc.
Another element that I do want to touch on is the surprise element of demand, right? Because so often we hear about these new technological advancements, but you look at the markets around the world and think, are consumers really quite ready for it? Themes like the Internet of Things, wearable technology, are these trends and themes that tend to pop up and maybe die down, or is there value of sustainability in some of the products that are looking to be developed here? Mark?
I think we're going to touch on AI, artificial intelligence, and I think facial recognition is actually quite important there. There's a number of companies listed, but particularly private companies. SenseTime is actually a very good example of that, where and China is quite well advanced here, where facial recognition is becoming a practical day-to-day reality, and with it comes security, and I think that is an aspect of technology that we're looking at today, in which sort of security issues and cyber-related issues around security have become very important. This has gone beyond the realms of defense and military into the private sector, and with it come very key commercial risks to your company and to your business and to your customer reputation. And so I think that's one aspect as well, where new frontiers are being pushed to the extent that we may not have actually sort of envisaged a number of years ago. And I think what's also quite important too, and per Andrew's point, that this is not new, it's evolved with us over many decades, is that many technologies that were pioneered through defense, military, and largely on country balance sheets, particularly in the United States and Europe, these technologies, which would not have been sort of commercially doable from an R&D point of view by the private sector, have now moved into the private sector. And so companies like Google, Amazon, Baidu, for instance, which is a Chinese company, are actually benefiting from research that was done over many decades, but which is now available not just for a very narrow purpose, but which is increasingly commercialized for sort of everyday use.
Well, let's get into some of those stocks and actually distill the investment perspective that might be available there. Let's get into our equities segment by taking a look at some stocks to consider in your portfolio. There's some interesting ones on this list here in particular, and Micron Technology is one of those that pops up. An interesting dynamic is that it probably features in many of the utilities that we make use of today. Right, Andrew?
Absolutely, yeah. So private client securities don't currently hold Micron, but if you want exposure to a company that builds the hardware or plays a part in the hardware role of this technology in this move to data and big data, then Micron plays exactly there. They build memory and storage devices, semiconductors, etc. As you say, they literally sit in any device that you can think of, be it your phone, your car, if your car's if it's an internet-based vehicle like these new cars are. Smart fridges, your computers, desktops, everything. So, Micron plays a role in any endpoint device that you use. And it's one of three businesses that I think dominate that industry. Samsung's another one, and SK Hynix, which is a South Korean business. So the three of them, which essentially then operate in an oligopoly, which might, cause concerns. But if you just think about, Mark touched on, through the cycle, but if you just think about the data that's been generated today, I think in 2017 I read that 22 trillion gigabytes of data was generated in 2017 last year. By 2021, that's expected to go up to 62 trillion gigabytes of data.
Goodness.
Now that's almost 3 times in 3 years. You know, so now if you think about through the cycle, so wherever DRAM prices might be today, through the cycle, that demand is going to be there, you know, over the next 1, 2, 3 years at least. And that plays directly to Micron as well as other semiconductor businesses. From a valuation point of view, which we were touching on earlier, and Mark said it, it's attractively priced right now. And I think the management team would agree. There's a share buyback of $10 billion that they've announced recently. And that's about 15% of their total market cap. So they're buying a huge amount of stock back, which obviously talks to management's belief that the company is very cheap or attractively priced, as well as the outlook of the business, that they believe, you know, the sustainable or the sustainability of the business model is in place. So I think it makes a very interesting case to get exposure to this technology theme through a hardware business.
Great investment opportunity there, no doubt. Let's move on to another company that is probably very familiar to members of our audience, formerly known as Google, but listed as Alphabet. Now, this is a company that touches our lives in many other ways as well. I think quite a number of people probably have Gmail accounts, access Google as a point of reference when it comes to searching for information. Is this still one to potentially look at, given that it is listed in the popular FANG stocks, Facebook, Amazon, not forgetting, of course, Alphabet, Google. Look, now I'm actually getting confused because of the Alphabet. Netflix, there we go. Is one of them which we'll also look at. Your thoughts here, Mark?
I think management are doing a pretty good job, Gugu, in transforming this business as time goes on. We typically associate it with search, but there's a lot more to Google than that these days. And so there's quite a lot of reinvestment in R&D and deploying into new technologies that I think will change the mix of this business as we go forward. And, you know, it's what, Andrew, about $750 billion market cap these days.
Phenomenal, yeah.
You know, we're probably looking at $1 trillion before we know it. You know, although it is relatively pricey, we must remember that, again, it is very cash generative, and management are, I think, doing a great job in deploying capital into new growth vectors. And so I think whether you're looking at Google, whether you're looking at Amazon, whether you're looking at Baidu, for instance, Baidu is an interesting opportunity, which is a more China-focused one, but has sort of similarities with these US-listed companies that we're all sort of familiar with. I think we could almost call it an asset class, I think, Andrew, you know, and it's although, you know, FANG is a much spoken about sort of acronym these days. Again, I think, you know, these companies are profitable. They're high growth companies. They're actually inventing the future. And so with that comes a new pricing dynamic that may have been absent a number of years ago. And so the fact that they may be pricey on the surface by our more conventional metrics doesn't necessarily mean that they make for a bad investment.
Here's a question that you probably get, especially from your private clients here, Andrew. Given that a lot of these companies that we're talking about, as you say, are cash generative, so we're not looking at net asset value and other valuations on these stocks, does this mean that the dividend payouts are also quite significant? So a strong dividend yield, which actually works as a benefit for Old Mutual private clients?
Typically not though, because they generate a lot of cash, but then they redeploy it back into their business to invest in new growth vectors, as Mark suggested. So if you think about Google, you know, they've got their DeepMind Technologies, which is a business in the UK that they bought, which is does research and development in the artificial intelligence space. What exactly they do is way too complex for me to understand, but you know, that's where they're working quite heavily. Waymo is their autonomous driving business, you know, where they're building vehicles, driverless vehicles. So they're redeploying a lot of this cash, not necessarily paying it out to investors, because they see huge growth opportunities in these various areas. You know, Amazon's another example, which I'm sure we'll touch on, that also just puts all of the cash back into its business to grow the business going forward.
So looking at long-term growth then, no doubt, but we'll get into some more of these factors as we unpack several more stocks coming up on the show, the likes of Amazon, Tencent, no doubt, Netflix, and an interesting another investment that you can keep your eye out for to add in your portfolio. We'll be back with more on Portfolio Watch right after this. Welcome back. You're still watching Portfolio Watch. My guests are still joining me in studio. Andrew Ditburner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Mark Ingham, Director at Ingham Analytics. Now, gentlemen, just before the break, we were taking a look at several stocks that we should consider to add to our portfolios when it comes to the age of artificial intelligence, as well as the fourth industrial revolution. And of course, we touched on Micron technology together with Alphabet, also known as Google. But Amazon was another one that we picked up on. And we know that this has certainly become one of the global giants here, Andrew, and I understand they're moving away from click to brick. Might be bringing drones into the market as well for delivery. So quite a lot that Bezos and his team are working on.
Yeah, there's a lot going on there. So Amazon's not traditionally thought of as a technology business. It's a retailer, essentially. And a lot of people talk about disruption. I think it might be a term that's overused. I think disruption could be, or competition could be another word for disruption. So they've competed in the retail space, going back to books, and they've used technology and leveraged technology to build a fantastic business, which is now, one of the biggest global e-retailers, along with Alibaba. But if you think about it, talking about what they're doing, you mentioned click to brick. If we think about Walmart, I think they just bought Flipkart. They're moving the other way. They're going brick to click. And Amazon bought Whole Foods recently, which is a brick and mortar type business. But they probably bought it for a number of reasons. One is to leverage technology in that business to make it more profitable. And another is probably to get data, or to get their hands on the data that business is able to generate from people buying foods. So they're doing a lot of things. There's Amazon Web Services as well, which is a cloud-based, one of the biggest cloud-based computing platforms. So if you think about IBM, Microsoft, and Google as well, Amazon are right up there from a cloud computing point of view. So there's a lot going on, generating, they are profitable, despite when you look at their valuations, PE looks very elevated at, I think, over 200 times. But you've also got to understand that they're just plowing a hell of a lot of money back into this business. To continue to grow and grow in different areas.
What's the perception been, very briefly, from some of the clients that you both interact with regard to companies like Amazon, especially given the limited exposure that they have to sub-Saharan Africa? Is there still a significant investment appetite there?
So Amazon, they are most definitely focused on growing outside of the US as well. So I mean, US e-retailing only makes up about 9% of their total retail spend, but they're also looking at emerging market Asia in particular, trying to grow in Asia. They have dipped their toe in China. Whether that's going to be successful or not remains to be seen. But they definitely are focused outside of the US borders to try and grow and I suppose get into that growing emerging markets.
Testing space, the waters there, no doubt. Let's talk about another company a lot of South Africans are familiar with, purely given the local link. When we think Naspers, we always hear about Tencent, then we think China and technology. Tencent here. Is there an investment opportunity, Mark? How do you feel about this particular stock with a significant amount of exposure to China, where it's really leading the charge there?
A positive, and Andrew and I were chatting off air, is that it's listed in Hong Kong. You've got a good line of sight on the financials. It's a very innovative business. It pays a dividend, albeit small, 9 times covered.
Wow.
Which is good for Naspers, because I think it'll get close to $400 million in dividend out of Tencent this year alone. So yes, it is a company that you would want to still be exposed to. The price has come back quite a bit to around about the 400 Hong Kong mark. Therefore, I think from a new money point of view, Tencent is starting to look relatively attractive again, despite the fact that the share price has doubled roughly in the last year, 18 months.
That gives us headaches, because when we think Naspers, then we think Tencent, and of course that's the perception that a lot of clients must have that you interact with, Andrew. Yeah,
but I think, if you look what Tencent have done over recent years and the ecosystem that they've built, they touch people's lives everywhere. It's quite phenomenal. If you think of their platforms, their social media platforms, WeChat is one of them, and they sell movies, they sell, you can play games online, you can buy games, you can, taxi drivers use, on their WeChat platform, to navigate, to, make payments. You can, we've seen Walmart now recently, I think last week, partner with Tencent from a payment point of view using their WePay. So that ecosystem touches lives across, different channels, which I don't think is matched anywhere else in the world. It makes it an incredibly powerful business. And if you think about their users, just on their WeChat platform, they've got 1 billion monthly active users. You know, the Chinese population 1.4 billion. The average Chinese person spends 5 hours a day on their phone, and which is a huge amount of time if you think about it. And 55% of that time is touching a Tencent business, whether it's WeChat or one of the other platforms. So, you know, there's a huge amount of data that they're able to collect and monetize, which makes it incredibly powerful and probably unmatched around the world.
Talk about new ways of socializing, no doubt, and capitalizing on that opportunity. Netflix was also one of those that we touched on when we highlighted the FANG stocks, and that's always proven to be quite a popular favorite. Mark, I understand this is one that you tend to take a look at quite closely at Ingham Analytics.
Yes, it's just quickly, it's a company that I think is turning upside down the Hollywood establishment and investing significantly in own content, and it actually sort of expenses that. So what you're doing is you're investing today in future cash flows, and the business is in fact finding a growing audience. I think streaming is the new place to be, and Netflix is right square in that. International is expanding dramatically and will be a growing proportion of their revenue base growing forward. In 3 years, probably the largest single source. And they are also cleverly localizing, whereas they actually need to do so. So I think that and IQE, which is their Chinese equivalent.
Tell us about IQE.
It's a fairly big market cap now, actually. You can buy it in the US. Baidu is their parent company, and they have a very similar business model too, albeit starting from a lower base. As Andrew has mentioned now, the usership numbers in China boggle the mind. So watch the space with this particular stock.
Sure. So IQE is certainly one of those that we need to keep our eyes out on, and the potential opportunities there. Andrew, how do you include Netflix as well as IQE?
So private client securities, we don't invest in either of those businesses at this stage. I think the interesting dynamic, and Mark touched on it, was that Netflix are now trying to build their own content, and I think there's a debate between distributors of content and producers of content, and you can think of Disney, for instance. So Disney are now moving the other way. Disney obviously make the films, and now they're starting to stream it themselves, whereas Netflix is going the other way. So who the winner is going to be at this stage, we're not sure, but we own Disney. For a number of reasons, from a media company. Netflix, funnily enough, just overtook Disney from a market cap point of view.
Wow.
But if you look at the fundamentals, Netflix is burning through piles of cash. I think it was $2 billion last year. Disney, produced $2 billion of operating cash flow on a monthly basis. So they're cash generative. They've got their Disney parks. They're producing the content, and they're moving into Netflix's space as well. So, we prefer the Disney to the Netflix. But I suppose time will tell.
Question is, who's taking the mickey out of who here, right? But with that said, though, as we do wrap up the show, just very briefly, when it comes to a variety of sectors, we always look at fundamentals, right? With banks, we know that you take a look at ROE, look at the operating environment with regard to investment opportunities and the likes. If it's mining, you're taking a look at the volumes regarding the minerals that they're able to get out of the ground. With technology, we've touched on so many things, and for us at home, it might be confusing. So when it comes to investing in technology companies, what are the basic fundamentals we need to look into very briefly to make sure that we're onto the right track? Andrew and Mark.
I think it's incredibly difficult. These companies are new, they're evolving so quickly to, just simply blindly apply your old school thinking around looking at a PE ratio. I'm not so sure that's very relevant. You can get different models. You can look at the number of users, what it costs to bring on a user, versus the revenue that an additional user brings. So if you look at a user model, that might be an interesting way of looking at a Netflix, for instance. If you're going to look at a PE, it's 200 times or 250 times. It's nonsensical. But you might also just have to look at the cash flow. For instance, in Amazon, look at a price to cash flow and a price to revenue point of view. Through time, what does it look like today versus a year ago, 5 years ago, etc. So that might be. But I don't think there's a black box, one size fits all approach that you can just apply to these new technologies and say, that's cheap based on this or that's expensive.
Makes sense. And I guess just looking at the consumer opportunities as well. If there's demand for their product, that might be a part of the fundamentals, Mark.
And the other thing is the people factor. Ultimately, the P&L is a function of the people. So it's who's managing it, who are they employing, why are they employing them, what are they achieving through that. And that people aspect in any business, particularly in these fast evolving businesses, where sort of traditional metrics, as Andrew correctly mentioned, are not necessarily relevant when you're looking into the future. But oftentimes you've got a lot of clever people doing some very clever things. And often that can be a good indicator, particularly when they're raising capital, because oftentimes with unicorn companies particularly, and then evolving into listed public companies, the ability to go through various rounds of capital raising is actually quite key. And when a company is not actually making money in those early stages, but possibly will, the confidence of investors to put money in is a function of the confidence in the people that they're actually putting the money into.
Exactly. Yeah. Backing people, one of our most important resources across the globe. So could work in line with the technology as we've been discussing today. Gentlemen, thank you so much for your time and for giving us some perspective on the dynamics regarding the age of artificial intelligence, big data, and all things having to do with the fourth industrial revolution. Thank you to my guests this evening, Andrew Ditburner, Chief Investment Officer at Private Client Securities for Old Mutual Wealth, and Mark Ingham, Director at Ingham Analytics, joining us this evening. Now do be sure you can also email through your questions, and we'll be sure to answer them here on Portfolio Watch. Email us, portfoliowatch@abn360.com. Until next week, have a good evening.